And we were able to attract quite a significant amount of capital then, and that was the first wave of real progress on the part of the private entity.
All right, ladies and gentlemen, welcome to Working Capital, the real estate podcast. I have, as usual, a special guest today. His name is Michael Emory. Michael is the founder, a trustee, and the president and CEO of Allied Properties Real Estate Investment Trust, a leading owner, manager, and developer of A, distinctive urban workspaces in Canada's major cities, and B, network-dense urban data centers in Toronto that form Canada's hub for global connectivity. Mike, how you doing today?
Just great, thank you. How are you?
I'm doing fantastic. We were just kind of joking around that we've got our first real snowfall, so I think everybody's excited to get the skis and the snowbirds out.
Yeah, I had to shovel my way out of the driveway to get down to the office, but it wasn't too bad.
Awesome. Well, Michael, thanks so much for coming on the show. I think, what we typically do with guests is take a step back and ask them, what their first relationship with real estate was and kind of the origin story of what that light bulb moment was that geared your focus on real estate.
Okay, well, in my case, it actually goes back to law school. I went to law school in 1979 at the U of T because my father had mentioned to me that he thought it was one of the more versatile forms of training a young person could get. And that resonated with me in a big way. And I loved the 3 years I spent at the U of T Faculty of Law. And I also concluded fairly quickly that I didn't really want to practice law for the duration of my career. I thought it was a wonderful gateway. But I didn't want to practice indefinitely. I was very fortunate to join as a summer student, an articling student, an associate, and ultimately a partner with the Aird Berlis law firm. And it was there that I got an opportunity to see what real estate was really like in the world. I was a securities lawyer, but we advised a number of issuers in the commercial real estate space, and I got a bit of a perspective on what it meant to engage in commercial real estate. Although I have to confess, at best, I had a slight inkling and nothing more. But I was young enough that I decided I could do this well, and I wanted to do it. And it took me 2 or 3 years, but I finally found a way to launch a very small private enterprise in 1988. It was called Allied Canadian Corporation. It was a name that sounded much more vast and much more important than the reality, that's for sure. But I was fortunate in one respect. In fact, I was fortunate in many respects, but I got to enjoy about 18 months of modest success because we were at the tail end of a real estate boom. The boom of the 1980s. I mean, before you were probably even born. But as importantly, I got to live through the collapse that occurred in 1989 and 1990. And basically, the real estate market collapsed for 5 years. The real estate industry in Canada collapsed almost in its entirety. All of the great names either collapsed completely or went through CCAA, some form of restructuring. And slowly an industry emerged over the course of the first half of the 1990s. It was brutally difficult, but never did I get a better education about running real estate than I did in the first half of the 1990s. I also was fortunate to observe that 2 brick and beam buildings that we had bought in the late 80s held up really well through those bleak days. And initially, with the towers sustaining 25 to 30% vacancy, with rents having gone negative net, I couldn't figure out why these funky little buildings in the St. Lawrence market area of Toronto were holding up so well. But as we thought about it, we realized there were really 3 things that were giving us an advantage in that difficult environment. 1, we were very close to the core. That was helpful. 2, the buildings had very distinctive internal and external attributes. That was hugely helpful because there were certain users that wanted to provide those attributes to attract, motivate, and retain their talent. And then three, the overall occupancy costs, especially the fixed taxes and operating costs, were very low relative to the towers, about $850 a foot compared to $22.50 to $25 a foot in the towers. So we could lease out at $20 all in and get to keep about $12. The towers were leasing out at about $20 all in and were losing anywhere from $2.50 to $5 per foot. They were negative net, as it was called at the time. So we had this advantage in those difficult times, and that's what guided us by the mid part of the 90s into the downtown West Marketplace and the St. Lawrence Market area to adaptively reuse older structures and to try to take advantage of that value proposition, proximity to the core, distinctive internal and external attributes, and lower overall occupancy costs than the conventional office towers. The last thing that did for us, and I'll stop, is it gave us insight into what users really wanted from their space. And what they wanted more than anything else was to create an environment that would be appealing to the talented men and women who were propelling their organizations. That was the focus. Cost was certainly relevant. Location was certainly relevant. But most of all, they wanted an environment that would attract, motivate, and retain these very talented, very mobile, very much in demand human beings that they needed to propel their business forward. And the last thing that this did, we didn't realize it fully at the time, but we ended up owning a huge amount of underutilized land. We had land that supported a 4-story building that was generating a very high return, but the zoning would permit 20 stories. So that, if you will, delta of 16 stories, if we could create it, we could create it without additional land cost. And that, of course, was really valuable. So by that point in time, we were public, and that's how Allied private entity evolved into Allied, the public entity, and access to public capital gave us the ability to consolidate these assets and ultimately to intensify them. So it wasn't as smooth and as logical as I recount the story, but that essentially is the story of Allied Properties REIT and the Allied business. And it took place over roughly a 30-year period. So it was not, there was no overnight sensation here. There was no overnight success. It was a long, deliberate, but I think generally very interesting journey.
Right on. Well, it's like that success line from A to B with all the scribbling in between, and it's that meandering path. Michael, I want to definitely get to the through the 90s, and I think the IPO was in 2003, and what that was like. That must have been crazy. But before we do, we have these U.S. and Canadian business leaders, and I'm always curious, going back to the original capital raising and how they built, especially in real estate, how they built the enterprise. So if you take us back to 1988, what was that environment like for raising capital? And my guess is it had to be kind of your circle of trust at that point, maybe your friends and family, and for the seed. And what was that experience like?
That's exactly right. It was friends and family, quite literally. Now, it was possible then to get enormous amounts of debt capital in relation to the value of the assets. Just enormous. In fact, it was not uncommon for people to commit to buy a building and to arrange a mortgage in excess of the purchase price, place it on the building, and actually profit on the date of closing on a tax-free basis with mortgage proceeds in excess of the purchase price. That was not uncommon. It was crazy, but it was not unheard of. Fortunately, I wasn't smart enough to attract that level of debt financing. And maybe I was prudent enough to see the risk associated with it. It was probably a combination of good luck and good management, but it was very much friends and family at the beginning. Then by the mid-90s, it evolved a bit. We were credible. In the early stages, at best, we were inspired amateurs. By the mid-90s, we were credible real estate professionals. We knew how to run real estate. We knew what made it work, and we knew what didn't make it work. And we were then able to attract what I might call capital from fund managers, not quite private equity, but really large fund managers who wanted to have their clientele invested in real estate because it didn't correlate with the equity markets. So they wanted non-correlated investments because the equity markets didn't always do well. And this might give their clientele a better overall outcome in changing environments. And we were able to attract quite a significant amount of capital then, and that was the first wave of real progress on the part of the private entity. It then acquired the Sable portfolio in 99, or 98, and that was a 1 million square foot portfolio, 18 buildings. And basically, we systematically, adaptively reuse those buildings. And then we bring it to 2003. Then we realized that we were onto something. And if we wanted to consolidate and adaptively reuse on a scale that was truly large, we needed public capital. So the private capital, in a way, vended into the public entity. And then we carried on and became a serial issuer of equity. And then by 2014, we had a credit rating, so we began to establish a debt capital markets or bond franchise, and we've since become a fairly consistent and successful issuer of that kind of capital as well. So that's kind of the capital spectrum. And it's interesting, today I keep asking myself, as a matter of interest, could I do today what I did in 1988 and beyond? And it would be a lot harder. The barriers to entry are much higher now. That doesn't mean there aren't, imaginative, creative young people who will find a way. And given the proliferation of private equity, getting capital today might be easier than it was in my day, but getting access to opportunity is probably vastly harder because real estate has consolidated in very, very strong hands, and it's really hard and really expensive to buy in now.
Yeah, I think it was you I was listening to on a panel a few years ago, and it was this idea of the negative correlation between capital being out there and the ability to find deals. And, capital's out there, it's everywhere, and then you can't find deals. But when you can find deals everywhere, it seems that there's not a lot of capital. I want to talk a little bit, before I move into the IPO, and get your take on what that experience was like. We've heard the term, I don't know if it was Sam Zell that coined it, the stay alive till 95, for every commercial real estate professional that had been around at that time, they talked about just getting through that time. And you mentioned in the first 15 months, you had a lot of success. Talk about a bit after that, and what were the challenges, and how did Allied and yourself, how did you make it through those times in the early 90s? And was it, like you were talking about before, a function of the fact that you had these very unique assets that seemed to be able to potentially weather the storm a little better?
No, you know what? Not really, although that was very helpful to us as we evolved. But I think what got us through the first half of the 90s is we created what was a small transaction-based business. We'd buy and syndicate assets and manage them going forward. That business literally ceased to exist in about March of 1990. So the way we survived was by transforming ourselves from a transaction-based business essentially into a service business. The one growth area in the first half of the 1990s was real estate trouble. So in fact, what we evolved into was a firm of troubleshooters. We helped lenders, we helped syndicates, we helped individual owners grapple with the challenges they were facing in relation to their real estate. And we actually became good at it. And to the point where banks would even have us installed because we were able to help the owners understand what their prospects were. And there were really three prospects back then. You were either dead on your feet and you had to find a way, if you will, to die with the smallest negative financial impact possible. That was easy, actually. And there were some cases which were clear turnaround situations with a little bit of capital and a little bit of resolve. This was a great piece of real estate, and as long as we could survive to 95, we would live to fight another day and preserve our asset. The really difficult issues were the people in the middle. They weren't necessarily dead on their feet, but it was not altogether clear that they could survive. And so we survived by becoming an advisor, essentially. And we did reasonably well financially. We didn't make a lot of money, but we paid everybody, we honored all our obligations, and we were able to generate modest salaries for ourselves and sort of stay alive. But the most valuable part of that 5-year period wasn't really the money we generated. It was the knowledge we accumulated and the information we corralled through that exercise. That had a huge positive deferred return for us. So the current return on our efforts sucked. But the future return or deferred return, as it turns out, was really quite significant. So I look upon that 5-year period as the most formative 5 years in my entire career. It was the hardest, it was the most disheartening, it required the greatest amount of positive thinking and positive energy and determination, but it was also the most productive in terms of really understanding real estate.
Yeah.
And real estate is a business. It is anyone that says real estate is an investment is profoundly wrong. It is a business, and it has to be understood as a business. And that's when we learned that fact that real estate is a business. There are real live human beings who are relying on you to perform certain functions and provide certain spaces. And if you don't do it, you're going to fail.
Yeah. Yeah. And you know what? It's funny. You just mentioned your alma mater, University of Toronto. There was a great white paper. I'll put it in the show notes for listeners. And it's basically titled The Commercial Real Estate Crisis of the 1980s and 90s. So for the younger people like myself and even newer in the industry that want just a slice of what happened and what the flavor of that time was. And we could talk about a bit of the similarities and differences to our current state right now. But I want to talk about what you've said. I've heard you say in the past was, if not the most, probably one of the most difficult times in your, or most challenging times in your professional life, the IPO in 2003. You know, maybe you could talk a little bit about what that experience is like and how you made it through.
Yeah, you know, it was brutally difficult in retrospect. And of course, your mind has a way of smoothing out all the edges. But when I think deeply about it, it was extraordinarily difficult. And I have to acknowledge one thing before I start. We were the second wave of public real estate entities. The pioneers, RioCan, Ed Sunshine, CREIT, Stephen Johnson, Summit, Lou Maroon, H&R, Tom Hofstede. Those guys were the pioneers. They went first. And Tom Schwartz, I should never forget. Tom was one of the great pioneers as well. They went first. They took the slings and arrows. So by the time we came along, there wasn't as big an education process to go through with the equity capital markets. But what made it so difficult for Allied was two things. Number one, we were quirky, and that's probably a polite way to put it. Nobody had heard of Class I office space. People wondered why you would invest in 100-year-old buildings when there are actually new buildings that you can invest in. So we were quirky. We required a bit of comprehension. There was a story that needed to be told, and I think we did a pretty good job of telling it ultimately. And there were some key institutional investors, thankfully, and I have to acknowledge Century Select, Sandy McIntyre, CI, Ben Chung, and a group in Vancouver called Cypress, who saw what we were doing. They got it, and they took a position, and that ultimately allowed our IPO to complete successfully. And they knew, and this was the second problem we had, we were ludicrously small. We basically raised $62 million and had assets of about $120 million. And in the context even of the Canadian capital markets, that was laughably small. In the context of the US capital markets, it was unthinkably insignificant. But once we got done, here's the good news. And the investment bankers kept saying this to me, and I didn't believe them at the time. They said, listen, if you get through this and you can deliver what you're representing to the unit holders you can deliver, you'll be shocked at how much capital you'll be able to raise and how easy it will be for you to raise it. And they were right. And here's what made a brutally difficult process ultimately very successful. The story or the strategy was very sound. Consolidating assets that had those three attributes around Toronto's core, close to the core, distinctive, available at lower overall, that really worked. The demand for that went up and up and up, and our ability to satisfy that demand got better and better and better as we consolidated more and more. So the story actually resonated because it was in sync with how the market was evolving. And even Americans came up at their initiative to meet with us because they understood the story. They knew we were ludicrously small, and what that meant to them really is they were making essentially an illiquid investment. If they bought $40 million of Allied stock, which you couldn't even do at the beginning, but as we got a little bigger, it wasn't liquid. So they had to bet on us in a big way. Fortunately, as I say, the story resonated, the consolidation really accelerated right out of the gate, and we stuck to our focus. We never tried to be something else, even though all kinds of other opportunities came to us. We stuck to consolidating the types of assets we saw as having a unique opportunity in the market. We then took that to Montreal and did the same thing, and then to Calgary, and then to Vancouver. So the strategy / story was sound, and we stuck to it, and we held ourselves accountable to it. So and there are so many, we came so close to failing on the IPO so many times. I keep wondering, if we had given up or if we had just hit the wall, a pretty material public real estate story would never have happened. Maybe someone else would have come along and done it, but probably not. And I'm so glad we persevered. I'm so glad the investment bankers stuck with us. I'm so glad our board persevered. And there was a very happy outcome to the story, but it was excruciatingly difficult. It's easier now to execute an IPO. And again, that's just progression in the market. But scale is important, and it's important because the market needs liquidity. And the only way you have liquidity is if you have a large number of units in the public capital markets that can trade every day. And of course, we now very much have that, and our, by American standards, we're still maybe small to medium cap, maybe more medium cap, but by Canadian standards, we're definitely a large cap.
So was the challenge with the IPO, I've always wanted to ask this, was it in terms of, you mentioned the nature of the asset, brick and beam was at that time, maybe that was one of the challenges, but was another challenge of it, was it the valuation of the assets? Was it, what cap rates do you use for what market? Because that type of valuation would have already been done with the IPOs that you had mentioned. So was it just primarily the nature of the assets?
It really was, because the valuation was addressed in the yield. We went public to yield either 10.2% or 11.2%. I mean, it was horrific. Yeah. Fortunately, we'd created a lot of value, so the value creators were able to get a good return. But we went public, I'm pretty sure it was 11.2%.
Wow.
So that addressed the valuation issue. Yeah. Nobody had any problems there. The market basically extracted that very, very, if you will, generous valuation from the market's perspective from us. And that's what we had to do to clear the market. So we addressed the valuation issue that way. And I think it was ultimately the asset class. And again, in fairness, the IPO did get done. And we were ultimately successful in articulating the strategy and telling the story. And people believed in the story. Yeah. And invested based on that belief. But the biggest challenge was getting people to see this as a potential asset class, not just sort of a goofy little niche that may or may not prove to be part of a trend. One thought was, well, this is just a fad. This is a cute little fad. It'll pass. And what happens then? Another thought was, well, this is kind of nice, like what you guys are doing, but how can you turn this into a big business? This is a nice little niche, but can you give this scale? And even we had to recognize then, I couldn't stand up. I would never have stood up and said, we'll be a REIT with a $5 to $7 billion capitalization, a decade and a half down the road, which we were. But I mean, I would never have imagined that. I remember telling one of the institutional investors that maybe we could grow off the little base, at the rate of 25% a year or so. Mm-hmm. And he said, if you can do that, and then I thought, oh shit, what have I promised? But we actually grew the asset base, if I remember correctly, at around 35% per year. Wow. And that compounds pretty fast. And we were successful in doing that. And I think we've been successful in doing that through the 18 or 19 years. But it was the nature of the assets and whether that could be anything other than a nifty little niche business. And I think one of the things I think the team at Allied can take some pride in is we demonstrated unequivocally that this was the foundation for a very large business, and we are one of the largest owner operators in Montreal, in Toronto, in Calgary, and we're getting to be, but we're not yet there, in the city of Vancouver. So I think it really was the nature of the assets and whether it could be anything other than kind of a cute little business. Yeah. And that was a fair question, actually. And some people thought, maybe this strategy and maybe this team has the ability to grow. I think we grew more than anyone, even our most optimistic supporter would have expected. We certainly grew more than we would have expected.
Yeah. Yeah, that's incredible, and kind of where you've come from there too, and just dealing with our company in the Well, the development in Toronto downtown in the West. It's the scale is it's pretty incredible. I wanted to fast forward a little bit to today. It's hard to talk about real estate without talking about COVID in some capacity, and the thing I always tell clients, it's almost rote at this point. You talk about multifamily doing well, industrial kicking along, retail, the story's fairly obvious. And then it comes to office, and office is kind of this kind of odd environment because there are certain industries that are doing very well, some that have been hurt tremendously. I'd like to talk about just your thoughts on office and COVID and how that has impacted potentially the way we work for, a prolonged period of time.
Well, it is a very interesting question, as you can imagine, or as you know, and it's a question about which there is quite a strong divergence of opinion even today, as you know. Here's my view. I think in trying to anticipate what's going to happen as we come out of this pandemic, and I think we all agree today that we will come out of it, and that probably that is maybe not imminent, but it's very much within the foreseeable future. I think that's widely accepted. So the conclusion I've come to, and it's a very important subject for Allied, obviously, the conclusion I've come to is we've got to focus on how people behave, not on what people say. Speculation is fun. Talk is cheap. Michael Emory is certainly going to suggest that the future of office space is bright. It's something he's paid to do and he's got a huge vested interest in. And some other dude who has a wholly different perspective on the world might contemplate the entire organization working from home full time. Mm-hmm. In both instances, the talk is cheap. What Michael Emory does is relevant. What the other dude, whoever he or she might be, does is relevant. So what we've been trying to do since we reopened on the 6th of July, 2020, is evaluate what our users are actually doing. Whether they're renewing their space, whether they're leasing new space, whether we're able to get the rents from them that we expected to get under the circumstances, whether they're telling us that they plan to return with their entire workforce to the office, et cetera, et cetera, et cetera. Here's what we've learned to date. I would not characterize it as definitive. The debate is not over, but here's what we've learned. We learned that in terms of renewals in 2020, we achieved everything we expected we would pre-pandemic. We renewed 80% of the space that came due in the year. Our high water mark is 85. Our low threshold is 75, so it was right at the midpoint. We achieved an average annual increase in our rental rates of 17.3% for that space. And there were some drags in the city of Calgary, but on a net basis overall, we achieved an average increase of 17.3%. That compares to 18% in 2019, so essentially the same. That doesn't tell a whole story, but it's indicative. Yeah. Then we look at new leasing. This is an amazing statistic, and it is 100% accurate. Allied did 258 lease transactions in 2020, and your firm was involved in a number of them. 103 of those transactions involved new tenants to the portfolio. So think about that. Yeah. I don't know in terms of area what those 103 represented relative to the 258. I should, but I don't. But 103 new tenants in 2020. Again, that's suggestive. Last but not least, we have been in constant communication with our users across the country, and they're indicating to us that they plan to bring their workforce back to the office, A, because their people want to be back, and B, because they want their people back, but they're only prepared to do it, quote unquote, when the pandemic is over.
Yeah.
And so when we were hearing this probably in the third quarter of 2020, and even then no one knew when the pandemic was going to be over and what over was going to look like. The advent of the vaccine, however difficult the distribution has been subsequently, had a big impact on that. So all the indications we're getting so far, all the behavior that we can observe, forget the talk, all the behavior that we can observe suggests to us that the underlying strength of the markets we're in, most notably Montreal and Toronto, although we're very much active in Calgary and Vancouver as well, but not on the same scale, that our users plan to return, and that the future of office space won't materially be altered by the pandemic. Now, again, I don't assert this categorically because I don't have enough data to support this assertion, but that's what I sense. That's what's indicative from what we've learned. We've even recently concluded a transaction at the Well, which your colleagues would have been on the listing side of, with a law firm for 30,000 feet. And it's immensely significant for three reasons for Allied. Number one, here was a knowledge-based organization that came to the conclusion that they had to operate from collaborative collective workspace, period, full stop. They did not have a choice in their view, number one. Number two, they had a pending renewal 2 years out, and they wanted an environment that would help them attract the most talented practitioners they could attract. And they concluded that the Well, it's a beautiful floor there or two they're on, would help in that regard because of the amenity-rich environment. And then finally, for us, what was significant is it was the first time a law firm has made a large-scale, long-term commitment to our space anywhere in the country. And what we're seeing is professional services firms are beginning to migrate to the kind of space we provide for the same reasons that the knowledge-based organization or the more tech-oriented businesses have migrated there in the past. They want the amenity-rich neighborhoods. They're very sensitive to wellness. They're very sensitive to sustainability. So if I had to guess from all of this, and it would only be a guess at this juncture, I think what the pandemic will do to urban workspace is increase the emphasis that was already evident pre-pandemic on wellness, on sustainability, and on amenity richness, either within the building or within the neighborhood surrounding the building. Those trends were glaringly evident pre-pandemic. I think they will be even more pronounced post-pandemic. I think the one area that will be most profoundly impacted post-pandemic will be air handling. It's been evolving meaningfully over the last decade and a half. As you know, some people are advocates of the underfloor air system. Allied is definitely one of those advocates, and it has worked very well for us. And we believe it represents a superior form of air handling generally, and certainly if we're talking about minimizing the impact of pathogens, aerosol pathogens in the air. So I think that's where a lot of brain power will be dedicated and those systems will be improved. But they have been improving for decades now because they have huge impact on how people feel when they're in the space, and how alert they are, and how well, actually, if you're breathing recirculated air, not so good for you. If you're breathing air that's got a good refresh rate and is properly filtered, much better for you as a human being. So that's where I see it going. But I can't, I don't want to say mission accomplished today.
Yeah.
Now, I'll tell you one more thing I've been saying to our investors. I'm very interested in what the Canadian chartered banks are going to do, because that's maybe the one big unknown. And in Toronto especially, they're incredibly influential. I think the announcement of Scotia's renewal at Scotiabank, at Scotia Plaza, is hugely significant. Because what it signals is the commitment today, long-term, to, I think, around 120,000 square feet of additional space going forward on the part of Scotiabank. And they were definitely going to give back some of the space at Scotia Plaza because they committed to Brookfield's Bay Adelaide North to some extent. So that was inevitable pre-pandemic. But what the owners, KingSett and Aimco, I believe, what they achieved is a very strong, concrete indication that the banks aren't going anywhere.
Yeah. And
if anything, they're going to increase their now, again, I don't want to conclude that because it's only one of the 6 major banks, but I think that's a very strong signal. And as I say, that's the one area of visibility that's been less than ideal for us. What do the banks do? If the banks decided to put millions of square feet of space onto the sublease market in Toronto, that would hurt all of us.
Yeah.
That would set us back years, clearly. I don't believe that's going to happen, and certainly Scotia's decision is evidence of it not happening with Scotiabank. And I don't run the banks, I don't have any influence over the banks, but I don't see them abandoning space in any meaningful way in downtown Toronto. I really don't.
Yeah, for sure. I mean, it's been really fascinating to see the sublease market, in addition, kind of where it was 2 years ago, a year and a half ago to today. We don't have too much time left here. I want to be just conscious of your time, Michael, but maybe what we could end with is you had a ESG report, environmental social governance report. I thought we could end it there and talk a little bit about that report and the impact of ESG when it comes to not only your company, but real estate companies in general today.
Yeah. I think the ESG evolution has been accelerated by the pandemic. Again, it was very pronounced pre-pandemic. And in fact, we committed sometime in 2018, I believe, to our unit holders that we would, by 2020, submit to a GRESB assessment and provide our inaugural ESG report. And that was actually an enormous amount of work. When I made the commitment, I didn't make it glibly, but I didn't fully appreciate how much work on the part of a broad cross-section of the team would be required to actually do these things well. But we learned and we did them, and we fared well for a first-time submitter under the GRESB assessment, although there's lots of room for improvement at Allied. But we now have a rational framework within which to evaluate ourselves, where we're strong, where we're weak, where we're somewhere in between. And we have a rational basis to measure, to establish priority and measure improvement going forward. I'm thrilled about that. The board is fully supportive of that. ESG is not a fad, any more than Class I buildings were a fad back in the early part of the last century. ESG is not a fad. It is real. And what makes it real, ultimately, is the money. And the people who invest huge sums of money globally in real estate are basically saying, listen, we have noticed that companies who are attentive to ESG tend to perform better than companies who are not. So purely as investors, we're going to be more disposed to invest money in a company that has successful ESG practices or a commitment to ESG. We're going to be more likely to invest in that company than one, all else being equal, that doesn't. So money talks, follow the money kind of thing. And I believe as well, in addition to that enlightened self-interest, I believe it is indeed our duty as a major real estate owner, operator, and developer in this country to minimize our impact on the environment, to create environments that are conducive to human wellness for the tens of thousands of people who use our buildings every day across the country. And finally, we are part of a broader community, and we have to be sensitive to the impact of what we build and what we operate on the larger community. And if we do those things, we will be more successful. We will attract more tenants. We will retain tenants with a greater degree of certainty, and we will have the support of the community, which in turn will, and we have a wonderful experience to draw on in this regard. We bought 1 million square feet in Montreal 6-7 years ago, big industrial buildings. And we wanted to adaptively reuse them for the kind of organizations we serve. There were a huge number of artists in those buildings. They were petrified that we were going to displace them. And what happens to artists is they keep going from great urban environment to, and then, savages like me come along and displace them. Now, we were sensitive to that. And long story short, what we did was we agreed to provide 200,000 square feet to an artist collective for 25 years at a reduced level of rent. That was partially justified by the fact that we didn't have to put the money into the space. The artists did.
Yeah.
So net effective, it wasn't as big. It was still lower net effective than we would get. But here is the amazing thing. The fact that we did that helped us attract the high rent paying tenants that came into the remaining 800,000 square. They came in because they knew we did this, because they knew they would never be accused of displacing the artistic community. So what I said to the province when we were part of a presentation on this was enlightened self-interest. Yes, it was the right thing to do. And I hope some element of that influenced our decision-making. But it was in our economic interest as well. And the fact that when your economic interest aligns with ESG, then ESG progress is going to be made. If there's no alignment, that progress isn't good. The alignment is getting better and better and better and more meaningful. As a result, ESG progress will be made in the world. Will it be perfect? Certainly not. But ESG progress will be made, not just because it's needed and it's the right thing for us to do with future generations in mind, but because it's in our interest to do it. And that's a great environment to be working in. That's why I actually love ESG, because it's kind of an aligned environment where the money is aligned with the issuers who are in turn aligned with the communities of human beings that we have impact on. So I think it's a terrific thing. And we have a long way to go as Allied to get to where we want to be, but we've started the journey, and we've got a rational basis for establishing priorities, and we've got a rational basis for measuring progress.
Right on. Well, another one for the books. My guest today has been Michael Emory. Michael, thank you for being a part of Working Capital.
My pleasure.